Good morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. Well, let's talk about Brexit. Brexit is pretty much roiling markets around the whole world. Okay, so let's talk about what this means. Basically, there's panic going on in these markets, and it's pretty ugly. I mean, the S&P and the NASDAQ pretty much undercut its support levels, taking out the May lows, maybe even heading lower. Volume's pretty high rather, and the selling is getting hit pretty hard. And I think it is a little bit of a panic, a little bit overdone. So we're just trying to tell everybody to kind of stay calm and look through this. So basically, with Brexit, it's an unknown, and it is perhaps that uncertainty that justifies the big sell-off. However, the assumption is that everything is for the worse. But no one really knows what's going to happen because there's a lot of assumptions going on and opinions, but no one really knows because no one's ever left the EU. And basically, the vote that was cast, it's really non-binding, although it's believed to be followed through. But no one knows when the 2-year process of renegotiation will even start. So it's a little bit of unknown, but doesn't necessarily mean that it's going to be for the worse. Perhaps Britain will even get more favorable trade agreements. That's all to be seen. We don't know. Now, technically speaking, as I was mentioned, the market looks pretty bad. I mean, real bad. All the support levels on the S&P and the NASDAQ got hit hard, and we're waiting to see if it'll bounce or not. However, some of the other technicals, after Friday, I looked, and the NYSE advanced decline line on a weekly basis still hit a new high. Of course, on a daily basis, it was down. So that's a positive. And also some of the fear indicators. We like to look at the 1-month VIX over the 3-month VIX. That was inverted, and usually when that spikes, we're near a bottom. Now that bottom takes a few days to play out, but we usually start getting there. Similarly, on the CBOE, the put-to-call ratio, is the total put-to-call ratio or just the equity put-to-call ratio, all spiking well above 1. Again, that's usually, or at least in the last few years, when we see such spikes, markets tend to bottom. And of course, it's sort of a non-economic event, and usually these events don't last too long. Now, of course, it's easy to say, it's a little uncomfortable if you're holding long positions to be sitting through this, but that's the nature of the market, especially this volatility that we're seeing over the last few years. Now, fundamentally speaking, I know it's silly to talk about fundamentals when the market's just getting ripped apart. However, this fundamentally speaking, no recession in sight. We look at the leading economic indicators, still pointing to moderate growth. Retail sales continue to be at all-time highs. Last week we got reports on the chemical activity barometer, which is a good barometer of overall economic activities. That's expanding. Truck tonnage expanded in May as well. So all these things are pointing to fundamentally a very good market. So in the short term, what's one to do? Well, if you're a short-term trader, you either want to be raising cash or you don't want to be over trading too much because the volatility may whip you around. If you're a long-term trader, sit through this. Usually these things do tend to resolve themselves within a few days. Look for that bounce. If you have cash on the side, you may want to try to nibble on some of your fundamental stocks if they're hitting support levels. But other than that, it is a time to be a little bit cautious, but not necessarily outright pessimistic. So, as always, that price and volume be your guide. Wait to see what happens towards the end of the week. This is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago.